Okay, so it should be going live soon.
Okay.
I think we may be live already. It goes live like pretty fast. Oh yes, we are definitely live. Perfect. I'm always really bad at this. I'm like, I think it's live. It's not live yet. Anyways, okay, so this is Zach Sparrow. I work with Keller Williams in Napa Valley and Solano County. I'm with Monica Jones, our preferred lender from Cross Country Mortgage. We're going to be discussing today how the virus has impacted the mortgage market and what people are experiencing. We have quite a few questions that go along, but I wanted to share how Monica and I met. Monica, so you go ahead and tell the story because she doesn't even know this was part of the conversation.
Okay, so I was looking on Facebook and I kept seeing this pop-up or this like advertisement of this guy with a champagne bottle in the vineyard, and it was a real estate ad, and I'd never seen an ad for a realtor that looked like that. And so as I was looking at it, I'm like, oh my gosh, this guy looks like fun. He likes to pop bottles. I like to pop bottles. We need to meet and we should be working together. We should be partners. So when I called Zach, I literally said, hi, you don't know me, but I saw your Facebook ad. I know you like to pop bottles. I can tell from the picture. I like to pop bottles too. So let's meet up for coffee. And he started cracking up and we met and we've been working together ever since.
So, and you were like a great find because first of all, you're like in the top 1% of loan originators, right, in the country?
Yes.
Yeah.
Yes.
And she is incredible, very, very smart, very intuitive with the market, really cares deeply about people. And that was one of my first real estate advertisements. It was like just me in the vineyard, like popping bottles and like telling people, let's celebrate. Let's like pop bottles and sell your house. Let's pop bottles and buy a house, you know? And I continue that through my signings today. I mean, I try to have sparkling wine there when ready. All right. So, and I'm just going to check. I just got a comment, of course, from my aunt. My aunt, my mom, everybody's been waiting for this, apparently. How do I get in? Okay, so let me go back to here. Uh-oh. Perfect. Okay. So I guess the first question for you, and you can shape the conversation in any way you want, Monica, but how or what have we been seeing with the rates right now in the mortgage market?
Ooh, okay. So what we have been seeing with rates in the mortgage market changes every single day. So going back the last couple of weeks, we've just seen extreme volatility. So more movement in the mortgage-backed securities or mortgage bond market in a single day, sometimes even in an hour or 2 hours, more movement in that short window than we've ever seen before. So we've seen interest rates trade as low as in the low threes for like a 30-year fix, and as high as the low fives. So that's a really big window in a really short period of time. So what that does for us is that, you know, we've got to have our head on a swivel and we've got to be paying super close attention to that market to be able to advise our clients on the best time to lock in their interest rates and when it makes sense. What we're seeing now, the Fed has stepped in. Once rates hit 5% about a week and a half or so ago, the Fed has stepped in and basically said that they are committed to buying as many mortgage-backed securities as they need to. So kind of like an infinite number they will purchase to help keep interest rates low. Now with the Fed doing that, they brought interest rates back down, but now we're seeing massive liquidity issues on the back end of the market for mortgage banks. And so the Fed is right now trying to balance keeping rates low without hurting the mortgage banking industry. So lots of movement, lots of changing and interesting times in the mortgage world, never a dull moment.
So what is your team doing? I'm sure you have some loans that are currently in escrow moving forward. What is your team doing to capture the rate when it's at, maybe it's low for the day? I mean, it's adjusting so quickly. Like, how do you even know, oh my gosh, it's, you know, low right now? Do you call your client immediately? Do you get a notification on your phone? How does that work?
Yeah, so we're actually tracking it. So we have it up on our screens at all times. We get text messages every hour on what the current bond is at for the hour. But if there's big movement mid-hour, we're also getting, you know, multiple text messages. So sometimes we're getting, you know, 20 text messages within, you know, an 8-hour window. for the market just on what it's doing and if it's moving. And there's times where I've had 5 or 6 text messages, rates are getting better, rates are getting worse, rates are getting worse, rates are getting better. Like we're just seeing a lot of, kind of like a yo-yo impact happening. So for us on a purchase loan, we can give advice on when to lock in. On the refinances, I'm really encouraging my clients to do all of the paperwork, get it all done up front. That way we have all of our ducks in a row so that when that right window of opportunity opens up, and sometimes that window is literally 1 to 2 hours. So when that window opens up, we'll have all of our ducks in a row, and then we can pull the trigger and lock when appropriate.
Perfect. Awesome. Yeah, I definitely have a client currently in escrow right now with Monica Jones as the lender. And this is why I love to work with you. And reason is that you're actually truly paying attention to where the rates are going. And there's a lot of lenders out there who have no clue where the rates are and tell their clients to lock. And they don't even understand where the movement is coming from or how the market works, the mortgage bond market works. So can you go into that? Why is the mortgage bond market so volatile?
For sure. And you're 1,000% right, Zach. A lot of times when you call, let's say online lenders, and not to bash online lenders, but you'll get someone to answer the phone and their goal is to close the client right there and get them to commit to a lock. That's always the goal versus giving advice or providing strategy to the client or figuring out how they can best position the client. So for us, that's super important. And I actually have a chart. It's a chart that I did from a presentation a few days ago, so I can show that to you now if you'd like. Let me pop on my screen here. Mr. Mouse, where are you? There you are. Okay. Okay, so we're going to share this screen, and I'm on a different chart, so I'm going to pop up here for a second. Just so
and for those of you that are watching on Facebook, you can go ahead and submit your questions. And we will go ahead and answer them towards the end of this. And we'll also discuss the CARES Act and how it affects the mortgage market also and maybe your own personal mortgage. So definitely stay tuned to the end of this because we'll answer some of those questions, but we'll also be talking about the CARES Act.
Okay.
All right.
So I just want to show you guys, this is, back to rates, back to interest rates. So this is something that as a loan advisor, I watch super closely. This is how I'm able to give solid advice to my clients on when they should and shouldn't lock in. So these lines right here, let's call them candles. This represents 1 day of trading. So each of these is a different day that the market is open and it's trading. And you can see this goes all the way back to the beginning of the year. Okay, so you can see, just to simplify things for this Facebook Live, green means it's good for rates. Rates are improving. Red means rates are getting worse. They're going up. Rates are increasing. So green is good. Red is bad in terms of interest rates, to simplify things. Anytime you see these little wicks, kind of looks like a candle where there's a wick. Do you see that? That means the market had tested a certain level and then it dropped back down. So that's kind of the spread that the market moved in 1 day. So you can see these little blips right here are kind of the normal market movement that we were seeing at the beginning of the year. And we can, take this back. If anyone's interested, we have this data, going back years, if you want to see how the markets move. But this is normal market movement. Now, what we've seen here, right, starting in March 9th or so, we're seeing massive movement in a single day. So for instance, all the way down here, and then the rates got really, rates went up quite a bit, and then they improved by the middle of the day. So if a client would have locked in here earlier on the day, they would have missed this entire opportunity for an improved price. So this is how, something that's super important for me as a loan advisor, so I can tell the client, great, now that you're in contract and we're in a position to lock, I recommend floating because I see the bond market's improving and we're going to be in a position to get you better pricing, midday or by the end of the day. Or vice versa, if I see we're starting off right here and I see the market selling off, I know I need to tell the client to lock in before we hit this bottom level here. So that's, really part of what my job is and how I can help give advice to the clients around when to lock and what we're watching. And it is crazy scary how many loan officers have no idea what that chart means or how to read it or how to track the bond market.
Yeah, I think the difference between you and I is that we come from an educational background, right? We're not trying to sell you on something. The goal is to educate
Right.
you to the right decision. And
Hmm.
so we have to then, if we're going to educate people, obviously that means that we have to learn it ourselves, which a lot of
Hmm.
agents and lenders don't learn it themselves. They know how to sell. And that's what they know
Right.
how to do. So I think there's a huge difference in that. Now, are you still seeing refinances? Because I know that that's just the kind of current matters. Are you still seeing people trying to refinance because they heard the rates were super low 2 weeks ago?
Absolutely. Yeah, absolutely. And rates are still low. It is still, for a lot of people, a really great time to refinance. So anyone who has probably, if it's a 30-year loan, a rate in the high threes or above, is going to have an opportunity to refinance. Now, maybe not at the moment, maybe not locking in today. My recommendation is not to lock in today. The reason for that is interest rates, where I see that bond market trading at right now, I know where rates should be. And right now, I will tell you, lenders are stepping on their pricing on purpose to slow down the refinances. They simply cannot handle the volume. And so right now, refinance rates, and not just one single company, I'm talking across the country, refinance rates are higher than they should be. They're artificially higher right now. So once we see everything settle down with what's going on with the coronavirus, once we know when we're going to come out of the quarantine, once things settle down a little bit, we will see pricing improve, and we will see, kind of that realignment of the bond market and where pricing should be right now. So for anyone who's interested in refinancing, my advice would be, now is not the time to shop 50 different lenders. Find one lender, whether that's me or somebody else, find one that you really trust and give them all of your paperwork, do everything up front, and allow them to, be in a position so that they can pull the trigger to lock and just know ahead of time what that target is. So for my clients, I'm saying, okay, here's the rate I'm targeting for you. It's not here right now, but I believe we're going to get there. Give me all of your stuff. This is what the savings is going to be. And then that way, when that rate hits, we're pulling the trigger to lock.
Smart. And what's nice right now is, property values are still appraising for things that sold about a month ago. And so potentially they may have 20% equity and they can, refi and take their PMI, property mortgage insurance, off their payment and save a little bit of money also that way. I just had a client with you, actually. We were supposed to use you as a lender when they purchased their brand new construction home. And they ended up not being able to use you, and then they just refinanced with you, and they're saving like close to $500, I believe, a month, or high fours on their payment every month, and they're having a baby. So super exciting for them to be able to save a little bit of money and move forward. So I guess a lot of people are coming to me, and I'm sure people are coming to you. They're saying, is this another 2007, 2008? Are we going into what they called was the Great Recession back when, right? And I'll give you my side of what I've seen in the real estate market before this started. I mean, the market was red hot. Refinances were going out of hand, kind of crazy. We had multiple offers, and that does sound a little bit similar to 2000, right before 2007, 2008, that prices were getting artificially high. But we also, also being on my side, I know that there weren't necessarily bad loans going out. Right? People were financing correctly. They had the right documentation. Everything was being checked thoroughly. So it's really not the same as 2007, 2008. So why don't, I know you had some piece from your presentation. Do you want to show a little bit about why you think this is not another 2008?
Yeah, let's take a peek
or
at
different
that
from 2008?
here. For sure. Yeah, I think that's helpful to see. So one of the biggest differences between today's market and the market we saw back in, or the market we saw leading up to 2007, 2008, this chart makes it really simple to see that, and that is the Mortgage Credit Availability Index. So what this graph should tell you is that back, before 2007, 2008, if you wanted to get a mortgage loan, you could. If you wanted to get 10 loans and buy 10 properties, you could, with really minimal or little to no documentation that you actually had the ability to repay those loans. You didn't even need to have a good track record on your credit of repaying your debts, and you could still buy multiple properties and obtain multiple financing. So the availability for consumers to take out mortgages was a very unhealthy combination of, you know, people taking out that debt and having access to it. What we've seen since 2008 is that now everybody who's in a mortgage has to document the ability to repay. So they have to have skin in the game. Their credit is going to be thoroughly reviewed. They don't have to have perfect credit scores, but they do have to show that they're, you know, a responsible borrower and a good credit risk for the bank. They also have to show they have the income to get the, you know, that mortgage paid off, which is something that was missing from the previous housing market. So everyone who's bought a home in today's world has shown that they actually can afford it. And you know, it's not an endless supply. It's not a buffet, like you can take whatever you want when it comes to mortgages, right? You do have to qualify in today's world. Another interesting piece regarding why 2007 and 8 is different than what we're seeing right now is simply the price appreciation that we saw. So what we saw, I think it's over 50% appreciation in the 6 years leading up to the 07, 08, you know, housing crash, which is just not a sustainable rate of appreciation. It's about 30% appreciation over the last 6 years from what we've seen in the current market, which is the historical average. So most counties in the Bay Area going back the last 60 years, so that takes into account a lot of markets in the last 60 years, most Bay Area counties are appreciating at around 6% per year. And I have the specific data for every county. If anyone's curious, just shoot me a message. I'm happy to send you the real estate report card for every county that has current historical and forecasted data specific for that county. So what we can see is the appreciation that we've seen is a lot more normal and it's sustainable, right? So we're not seeing the crazy appreciation that we've seen in previous years. All right, so then let's take a look at this slide here too. I think this is another one. So if we just look at basic economics, supply and demand, what we're also seeing in 2007, there was 8 months of supply of inventory, which basically what that means is if not another house was listed for sale, it would take 8 months before there was enough of a demand to eat up all of the current listings that were on the market. Now in today's market, we're about 3.1 months of supply. So when that supply and demand is out of whack, when there's too much supply, that also leads to unstable home prices as well. Something else that I think is, what were you going to say? You want to say something on that one?
Yeah, I definitely think that's true. I mean, at the moment, or even before that, I think it might have even been less than 3.1 towards the end, or like right when the refinances, like mid-March, things were just kind of crazy. I think that 3.1 was actually representative of potentially February, right? Of like coming out of the January market, which is a little slower because everybody's getting back into their normal routine out of the holiday season. So I actually think that months of inventory could have actually been less than that before the coronavirus started.
For sure, that's for sure. Now, something else that's really interesting is the amount of equity. So as values were rising very, very quickly in the previous market, in the 2007, 2008, and the years leading up to that, the amount of cash out that was taken out of that equity was about $824 billion. So what we're seeing now in the current market, which is a lot, that's a lot of money. So people were
using it as an ATM.
Yes.
ATM.
Yes.
Cash out refi, new boats. I swear everyone in 2006 had a new boat and a new RV and a new. Everything was new.
Well, and 5 houses, yeah.
And 5 houses, yeah. And they worked as a waitress at Denny's. Not hating on the people at Denny's. I'm just saying you shouldn't own 5 homes.
And a boat and an RV, probably, yeah. So
yeah.
So here's what we're seeing the last few years. So people have, what this chart should tell you is that we have a really healthy amount of equity in the real estate market right now. So most people, have equity built in. They're not like on the cusp of, oh my gosh, I'm going to be upside down on my house. Most people are not in that position today compared to how it was in the previous market. All right, let me stop there. Okay, I can see you again.
Good. Yeah, so much data all at once. Jeez. So, to piggyback off of that, I don't think the market is in a 2007, 2008. I think something you had mentioned too in a previous conversation that you had just with your agents, which was when we started this, we weren't already in a recession. Like the market was doing really, really well. So coronavirus is like, and the media is spreading fear. Don't get me wrong. I definitely do think it's serious. People should take it, take it strongly, right? All that information that's being provided to them and staying home. But I also think that they need to understand that this could potentially be temporary and the market could come back. So what are we seeing in the economy? I know you had a graph from Goldman Sachs discussing what the economy predictions were.
Yeah, let me pull that bad boy up here. Okay. All right. So here's a graph put out by Goldman Sachs, who's, they're a very well-respected investment research firm who, a lot of analysts will turn to for the data and the forecast on what's happening in the market. So what this will show you, so this dotted line here shows what the initial forecast was for our GDP, our gross domestic product, which means it was forecasted to go below zero, so have a negative GDP. This was the initial forecast, have a little bit of a small blip here and then come back. What's being forecasted now is a little bit of a deeper dive, and even this chart that I think is now about a week old has moved a little bit lower. So the line's a little bit steeper because, again, the market is moving so quickly and things are changing so quickly that, this is all a moving target. So what this chart tells us is that, yes, we are in a recession right now. What's interesting about a recession is, by definition, you don't know you're in a recession until after you're already in it. Because the recession, the definition of it is that you have 2 consecutive quarters of negative GDP. So we know quarter one, we do have negative GDP. I think it's about negative 9% is where we're going to land. So we're going to be somewhere right around here. We also are forecasting that for quarter two, right, going through June, we're going to see around negative 32, maybe 34%. So we're going to have a little bit of a deeper V shape here. But the important thing to keep in mind is that everything that we're seeing right now is all coronavirus related. Previous to this, we did have healthy jobs market, we had healthy real estate market, healthy stock market. So what this tells us is that what we're experiencing right now is purely because, our country is shut down, people can't work, businesses, can't operate or don't have the incomes that they normally have, which it is going to have an impact on the economy. So we are anticipating seeing this, recession last through quarter two, and then in quarter three, sometime in the beginning of quarter three, starting, July timeframe. So maybe by July, August, we anticipate we're going to come, out gangbusters and going to be rebounding even better, which will be nice to see.
Absolutely. And I have a question provided to me on Instagram, and this was, I had asked people to ask some questions beforehand. They said, will we see housing prices decrease slightly? I think there's a lot of millennial buyers hoping to see these major reduction in prices. And I'm going to say, I'll give you my point of view, and then I would love Monica to chime in. My point of view is that we are entering a recession. Prices will drop, but not as significantly as you may hope. So I think there's a lot of people waiting out there to purchase, and they're waiting in the waters, just waiting for the right time. And I think that when the prices do maybe drop a little bit, as long as they're still employed, they're going to be coming out of the water right now and trying to purchase homes. And I do think you'll have more negotiating power at the moment, but that doesn't mean necessarily that you should think that you're going to get $100,000 off the $600,000 home you've been looking for. I don't think that's going to happen. Mm-hmm. What do you think?
I agree. So what's interesting, real estate is really hard to show right now. Most of the real estate being sold is being marketed virtually, right? Virtual open houses and things like that. Or I've heard of some private showings that are happening with caution, of course. But we still have purchase contracts getting accepted. So people are still writing, and we are still seeing that sometimes buyers are not the only buyer writing on that house. So I think it would be silly to say we don't think housing will see any impact. I mean, our 401k is, our retirement accounts, right? Those are assets that we have. Our home is an asset that we have. If our investment accounts have gone down 30%, I think it's a little bit silly to think that our house hasn't decreased a little bit in value right now as well. But again, it's like a super temporary blip. We already know that come July timeframe, when we're on the other side of the coronavirus, things are going to pick back up to get back to where they were. So if there is a window of opportunity in terms of negotiating power, I think it would be during this window, which is kind of tricky since it's really hard to see property right now. But again, I don't think anyone thinking they're going to get a huge chunk of money off the house, I think has unrealistic expectations. And on a call that I did with some agents, I showed them, look, if a seller reduced the price of a house $10,000, that's going to lower the buyer's house payment maybe 50 to 60 bucks a month. It's not going to be life-changing to, get $10,000 off on a house and save 50 bucks a month in payment. But where that $10,000 does work really, really hard is if the seller wants to buy down the interest rate for a permanent buy down for that buyer. So when I crunch the numbers, let's say instead of a seller, if they need to sell the house, instead of reducing the price of the house by 10 grand, offer to buy the buyer's interest rate down by 10 grand. And within the first 7 years, depending on the loan amount, but that buyer could save $30,000, $40,000, $50,000 of interest just in that first 7 years by having their rate bought down. So I think there's a lot of ways to have the sellers and the buyers come out as winners in this market. If there's people who, there are people that do need to move right now and things are happening. So for the people that are making deals right now, I think there's a way to have it be a win-win for both.
Absolutely. And I definitely feel the same way. And I think people also lose respect and understanding for when interest rates increase, how much that increases your payment. Okay, you can buy that house for $500,000 that was 600,000, but if the rate is now 6%, let's just say it's 6%, you were better off buying it when it was 600,000.
Right.
And people just they don't necessarily understand how much rates take an effect. And I think part of that comes from the rest of the United States is not California. California loan amounts are probably a lot higher than a lot of other states because living here is so expensive. And so the interest rate takes a huge play in their payment.
Yep. Interest rate definitely has a bigger impact than the price on the payment. And also what you qualify for, because if you qualify for a $600,000 house now at a rate of 3.5%, you might not qualify for that house anymore if the rate goes up to 4.5%, right? That's going to erode your purchasing power as the rates go back up. So right now we have the government stepping in to keep rates artificially low. So if you're looking to, get the most bang for your buck as a home buyer, now is a great time to be able to do that.
And I'm going to just go, I'm kind of following off topic again, but there's a couple of questions coming in on Facebook. Catherine Darinelli said, this may have already been asked, but what about 15-year rates? Do you think you can find one under 3%? I just had somebody do a 15-year conventional fix for 2.75 2 weeks ago. So I don't know about currently. What do you think?
Yep, absolutely. All of the clients that I have that we're targeting, so remember how I told you the clients that are interested in refinancing, we've got their paperwork and now we're waiting for our opportunity to lock in and pull the trigger. Anyone who's getting a 15-year fix are all under 2, some well under that. So I definitely think that that's going to be a possibility in the near future.
And she has 2 other questions. Catherine's very talkative.
Thank you,
which
Catherine.
I love. I know.
I'm glad
she goes,
we're not
why?
just talking to ourselves here. That's good.
I know. She goes, why a mortgage broker? Why not just go to a traditional bank?
Well, that's a great question too. So you get the best of both worlds when you're working with a banker broker. So at my company, we have what I call 3 hats. So the first hat that we wear is we are a direct lender. So just like if you bank with Chase or you bank with Wells Fargo or B of A or wherever, they're a direct lender. They fund their own loans. They have their own set of programs and guidelines that they can work with. So we have that as well. So we're a direct lender. We wear that hat. That's one hat that we wear. But the second hat that we wear is we're also a correspondent lender. So what that means for you guys is that we underwrite for several different banks. So we have over 30 different banks that we underwrite for, which means we have their programs, we have their rate sheets, their pricing, their guidelines. So if you go to one bank, and I'm not going to call any bank out, but you'll be told right now that you probably need a 640 or a 660 credit score to get an FHA loan. That's because that's bank's guidelines. Where we have access to, a plethora of guidelines and programs. And if the program exists, we have it. And if the loan can be done, we can do it. And we actually sell directly to the agencies. So we sell directly to Fannie, to Freddie, directly to Ginnie Mae. So we don't have any overlays. So you're going to get the best pricing with us in terms of, we can look at all the different banks to see who's got the best pricing for your particular scenario. And one day it could be this bank. The next day when we're ready to lock, it could be another bank. So we basically do the shopping for you. It doesn't cost you any more money to work with us compared to walking into your bank, because there's a loan officer at the bank who you're going to work with who's compensated the same way that we are. So you basically, working with us, you get the speed and service of a boutique mortgage bank, but you get the really great big box interest rate and pricing.
Yeah, and I one of the things I like to mention right here, right now, is that when interest rates are extremely volatile like this, having someone like you and your team watching out for the clients, it's going to be much different than your big bank. Your big bank not necessarily going to be able to capture it in the right time.
Yeah, I have someone, we're getting deals right now from big banks. I have someone who says they placed a call 2 weeks ago to get a status on their loan, and no one's even calling them back. Like, they can't even get a response or a check-in or an update right now.
Crazy. Okay, so one other question, and this has happened a couple of times recently. We're here in Napa Valley. We've had a lot of fires in the past few years, earthquakes and things like that. Insurance has gone up for a lot of our clients that live closer to the hills or in the hills. With people that have outrageous, what they're saying, outrageous insurance policies, will refinancing affect them in any way?
No. So refinancing does not impact your property taxes or your home insurance. So you can keep that exactly the same. The only thing that refinancing changes is your current loan that you're paying now compared to the new loan that you're going to be paying. So, when we get clients' insurance policies in, a lot of times we'll reach out to them to say, it seems like you're paying a little bit too much. Do you mind if we reach out to an insurance agent to get a couple of quotes for you, just to make sure you have the best coverage and premium possible? And most of the time, people really appreciate that. And if there's an opportunity for them to save, we'll help them find that as well.
Awesome. Okay, so with this all being said, and I'm in the heat of it at the moment with some of my escrows, but should we expect delays on the loan side? Are appraisers able to get out there? Are people able to do their job? The homeowner associations able to provide their docs? Are the lenders able to do their job and get it done? So should we expect delays on the loan side for you?
So I would say everyone can do their job right now, but we are still seeing delays for a couple of reasons. So one, appraisers can still get out when they need to. Fannie, Freddie, and FHA just rolled out for purchases and rate and term refinances. They no longer need a physical inspection right now. So we can do automated appraisals, or the appraiser could do a drive-by appraisal. So they literally drive by the property, take a photo. They don't go in, they don't measure. So it's a true no contact appraisal. So those are happening right now. As far as HOAs, I just had an HOA that we've been trying to reach the HOA company for like 4 days. And finally got somebody to respond to us. And this lady, the HOA person, is working out of her house, but she's extremely delayed, which of course holds us up because we can't take the next step until we get what we need from that person. The other place that we are seeing some delays right now are we have to verify, not just us, but the mortgage world in general. We need to verify everyone's employment like extra 2 to 3 times throughout the process right now, because lenders are being very cautious because they know of, the unprecedented amount of unemployment that's happening right now. And so people even that were working a week ago may not be working, or maybe they have reduced hours, or maybe their overtime has gone down, right? All of those things are coming up right now. And so we're having to re-verify employment throughout the process, but again, like 3 days before they finally close. So if, like I've had this happen too, someone's company is open and they're working, but everyone's working remote, getting a hold of the right person, getting them to respond, sometimes there is a delay right now. So we can still move, but we're kind of being a little bit flexible and patient with everyone.
I think that's a great point for just educating our clients. Like, if your human resources department is working from home, you need to figure out how to get a hold of them from your boss and be able to get a hold of them so that when we do need to do verification of employment, you guys can do it pretty easily and hopefully not experience a ton of delays. And as hopefully HR doesn't get laid off. I know most companies look at HR as sometimes a cost versus a moneymaker. And so those people tend to be, I hate to say this, some of the first people that are let go, because if you're not recruiting or hiring at the moment, you don't, not necessarily, you don't always need HR unless you're a larger company. So just something to think about moving forward. And then I guess, and I'm just thinking ahead in the future, and I always do, Monica. I'm thinking ahead in the future. Clients, I had a lot of clients who are millennials who are getting gifts from their parents, financial gifts.
Mm-hmm.
I think those parents are going to be a little bit less giving moving forward because they may be unemployed or the situation may have changed for their businesses, whatever that situation may be. And then also, not to mention that these layoffs will affect these people's pre-approvals right now, right? So if you're unemployed, file for unemployment or unemployed for the next 2 months, let's just say, for example, and you get hired back, I mean, to the banks, you don't look like you have consistent income or employment, right?
Well, so there is going to be an exception, and we are in a bit of uncharted territory because there's, never been a time in our history where the government has told everyone to shut down. So I'm going to go out on a limb and kind of forecast how I think the mortgage industry is going to respond once the quarantine is lifted. But for right now, so yes, if you have been pre-approved, let's say, or you want to get a new loan, whether it's to refinance, if you currently are furloughed or unemployed, if you don't have your full income right now, you won't be able to obtain a loan, which is the hard part of, wanting to take advantage of the low interest rates when they're available, but also kind of having, your hands tied behind your back if you're not working or don't have your income. So that's, a definite reality. We got to show that you're working and that you're getting your income. As far as how it's going to look when you come back to work, I do believe lenders are going to basically allow us to ignore this quarantine period. So for example, if you go back to work and we're trying to average out your income and we have a 2-month period where we were on quarantine, and we could show that you were furloughed or you were on unemployment during that time because of COVID-19, I think we'll be able to omit having to calculate that into your income. So we won't have to hit you for that in a negative way. We'll probably have to write a letter of explanation, but you and the rest of the country are going to be in that boat. So I think we're going to be okay there. Now, if you were unemployed before COVID-19, that's different. If you're unemployed after, that's different. But during this specific period, I think we're going to see grace from the mortgage companies with that once you're back at work.
Absolutely. And for those of you that don't know, and I've learned a lot about lending and the history of lending within the real
whether
estate.
you like it or not.
Yeah, well, it's more about education, right? Educating your clients. Banks think, and you may correct me if I'm wrong, but banks think that single family homes are one of the most secure areas to lend money to because you typically don't want to lose the roof over your head, right? And you are before any payments made, you're going to make your mortgage payment typically, right? If you're worried about losing your home. So they tend to like to lend to that versus lend for a car, right? Or something else, maybe your credit cards, right? They're not going to give you the better interest rates. The reason why they encourage home lending is it's one of the best places for them to secure its most secure debt, and it's backed by actual property, something they can sell if you default. So I think that, moving forward, we talked about this a little bit, but the CARES Act has just been approved, and I know that there's some stipulations in there that will kind of help people. I personally have not received any phone calls yet of people not being able to make their mortgages, but I imagine, over the next month or 2 months, I may get that phone call. What can people do?
So the best thing for people to do, if you are in a position where your income is down due to, COVID-19, if you're not working or your income's taken a hit, reach out to your servicer. That's step number one. There's 2 different types of words you're going to be hearing. There's going to be forbearance, and then there's going to be deferment. So forbearance, what that means is it's kind of like, when you, let's say, buy furniture or something, they say, buy it now and you can pay 90 days later, right? No interest for 90 days, you pay it 90 days later. So forbearance is similar to that. So you would call your mortgage servicer, say, I'm struggling, I have reduced income due to the quarantine, and they will work with you. Right now, there's up to 60 days where you have, grace on not having to pay the mortgage payment. There's talks of extending that to 180 days, depending on how long the quarantine really does last. So forbearance, what that means though, it's not like they're going to forgive the money. You owe the money, you will have to pay it. So for forbearance, that just means you don't have to pay right now. You will have to pay it. They will set a repayment plan with you. Typically, they'll let you spread it out over anywhere from 3 months to 12 months. So just be prepared that if you're, not able to make the payment right now, that you are going to have to play catch up once the quarantine is up and, you're on that forbearance repayment plan with your lender. Deferment means that you don't have to catch up. What the lender is going to do is they're going to tack the balance and the interest owed onto the back end of your loan. So that's what deferment is, so that you don't have to pay a catch up once we come out of the quarantine on a deferment. So every servicer is going to have their own terms with what they're able to offer to you. So the best place for you to start is to call the customer service number on your mortgage statement and let them know that you've been impacted by COVID-19, by the quarantine, and they will walk you through their process and discuss the options that are available. But one of the things that I cannot stress enough is that don't do this if you're still working, if you still have your income, because what this does, I think one of the issues that we saw previously in the 07, 08 era is that even people that could afford to make their mortgage payment chose not to. They chose to walk away. And it was like a snowball effect for foreclosures and short sales. And what we don't want to see right now is people who have the income and the ability to pay their mortgage, but just choose not to so that, they don't have to. It's like, oh, if I don't have to pay it, I won't. Because we have to remember what this is doing on the back end of the mortgage world. And this is a part of the reason why the mortgage market is so volatile right now. If mortgage-backed securities market is, nervous about people, the amount of defaults that are going to start happening. Of course, if you don't have your income, absolutely call and, get on a deferment or a forbearance, game plan with your servicer. But if you can pay, do pay, because this is putting a lot of strain on banks and our mortgage market and the housing and mortgage market. That's a huge part of the health of our overall economy. So that would be my, kind of my 2 cents or my recommendation.
Absolutely. And I think that, with that being said, the short sale, so I just got my short sale foreclosure specialist because I'm in quarantine, and I'm also getting my broker's license. So for those of you that don't understand that, I'm a real estate agent salesperson. Yeah. Oh, I'm just doing everything. My backyard's beautiful. Everything's going to be done. My closet's done. Like you guys, I can't sit still for too long. I lose my mind. So I just have to work on stuff. So anyways, what I was going to say with that is what you're mentioning is what we call a strategic default. And it's actually completely against the law. For if you are able to make your payment, you should be making your payment. If you feel like your home's not worth it and you're still paying on it, unfortunately, that's still strategic default because you can afford your payment and you can continue to make your payment. I think people also forget that they are actually paying something off, right? The goal is to pay it off so you own it in full. Not many people do that part, but if they did and recognize it as that versus thinking today the market value of my home is, $500,000 and I owe $515, they would go a lot farther than where they are right now. Okay, so anything else with the CARES Act? I know that you had mentioned people that are, what did you say? Our business owners can get a grant or a loan option. Obviously, unemployment's it changed a little bit. I think they're going to try to provide a little bit more income to people. Do you have any word on that?
Yeah, so for business owners who have been impacted, the government has rolled out additional funding for SBA loans at a really low interest rate. I think it's 3 3/4, which is traditionally a very low rate for SBA loans. There's also an emergency advance that the government has approved up to $10,000 per business if your business has been impacted by COVID-19. And that is something with relatively, little to no paperwork. It's kind of like a good faith. You're applying online for it, stating you're, a business owner, your business has been impacted, and that $10,000 does not have to be repaid.
Awesome. Yeah. So, I mean, especially if you're somebody who employs other people, this is an
Mhm.
opportunity to really apply and hopefully get that 10,000 or up to 10,000 moving forward. Well, I do want to
Yep.
wrap up the phone call. I'm going to look through really quickly here and I'm going to ask
Mhm.
people on Facebook, if you are live with us right now and you have a question, go ahead and type it in and we'll answer that question right now. But I'm going to review because there was a lot of people watching. You're going to be happy. There was a lot of
Okay,
people
cool.
watching. So, and they have a lot to say. Catherine says she needs to talk to you about refinancing.
Okay.
So I'll connect you with her.
Great, thank you.
BB said she thinks I still need my boat because I'm trying to get. I want BB's boat. So BB wants to
Oh,
sell
there
me
you
her
go.
boat, and I think it's a need really because honestly I can't even vacation. So I might as well be
Well,
out
no
on the
one can do
lake.
anything right now, so.
I know. Is the lake open? I don't know. BB, that
Uh,
actually just reduced the price of your boat you were going to sell me. So I'm going to have to reduce. I need a closing cost credit, BB. Okay, so there's no other questions. Everybody said great info. So that was awesome. Thank you, Monica Jones. Do you
awesome.
have anything you want to add to this?
Thanks for tuning in. And like Zach said, we're here to be a resource. You know, that's what we do. I have a passion for helping people, Zach. I know you do too. So it's about getting all the information out, giving really good advice, and you know, doing our best that we can for our clients. So if anyone needs a resource, I'd be happy to help.
My girlfriend just told me the lake isn't open. She really doesn't want me to get this boat. All right. Well, thank you so much. I
All
love
right,
you as
guys. Thank
always,
you,
Monica
Zach.
Jones. And I hope we can talk soon about this as we get out of this and what maybe I'll have you come back on maybe 2 or 3 weeks in, or 2 to 3 weeks out of quarantine to kind of refresh
Perfect.
us on where we're at that point.
Yeah, for sure. I think that would be great. And things really are right now changing weekly, daily. So yeah, who knows? Maybe we'll be coming on before then. We'll see.
Yeah. All right. Thank you so much, Monica Jones. Have a
All
good
right. Thanks for
one.
planning.
Bye-bye. Bye-bye.